Have you noticed what's happening in the financial world right now? Bitcoin just crossed $117,000, and the move came right after the US Federal Reserve announced a 25 basis point rate cut. This isn't just a random spike in price, it's a signal, a story, and a warning, all rolled into one. Today, we're going to explore how the Fed's rate cuts are shaking up the entire investing landscape, why Bitcoin is reacting the way it is, and what opportunities and risks lie ahead for anyone serious about building wealth in this new era. For many in the United States, as well as in countries like the UK, Canada, and Australia, the Fed doesn't just control America's monetary system, it indirectly influences the world's financial heartbeat. When the Fed cuts rates, it doesn't only lower borrowing costs for US businesses and consumers, it also ripples through stock markets, real estate, and yes, crypto. That's why Bitcoin's surge after the rate cut isn't just a headline. It's a glimpse into how global wealth flows are changing in real time. Let's break this down from the ground up. The Federal Reserve made its decision to cut rates because inflation has been cooling off and economic growth has been slowing down. In simple terms, the Fed is trying to keep the US economy from stalling out completely. Lower rates make it cheaper for businesses to borrow and invest, and it makes mortgages and loans a little less painful for households. But here's the catch. Lower rates also make cash in savings accounts less attractive. Investors and everyday people start looking for better returns. That's where assets like Bitcoin, stocks, and even real estate come into the picture. Now, why Bitcoin? Because Bitcoin has often been called digital gold. When rates drop, traditional bonds and savings accounts yield less, so investors hunt for assets that could outpace inflation or deliver higher returns. Gold historically plays that role, but in 2025, Bitcoin has entered the mainstream in a way we've never seen before. Major financial institutions in the US are offering Bitcoin spot ETFs, meaning you can now buy Bitcoin exposure through your brokerage account as easily as buying Apple or Tesla stock. This is critical because it adds legitimacy and accessibility to Bitcoin. When the Fed signaled easier money, demand poured in, and the price soared to new highs. But let's not get carried away. Bitcoin's rise after the Fed cut isn't purely a victory story. It also comes with risks. Volatility in crypto hasn't disappeared. In fact, on the very same day Bitcoin hit 117K, it swung thousands of dollars in a matter of hours. For seasoned investors, that's opportunity. For newcomers, it's a potential trap. And here's the bigger picture. Rate cuts usually mean the economy is slowing. If we're heading into a softer US economy, will risk assets like Bitcoin and stocks hold up? Or are we just seeing a short-term sugar high? Let's put this into context with some history. Back in 2020, when the Fed slashed rates to near zero during the pandemic, Bitcoin exploded from under $10,000 to over $60,000 within a year. Investors who understood the relationship between easy money and scarce digital assets made fortunes. But in 2022, when the Fed raised rates aggressively to fight inflation, Bitcoin crashed, losing more than half its value. So here's the lesson. Bitcoin and rate policy are deeply connected. It thrives in environments of loose monetary policy, but it struggles when money tightens. So what does this mean for you right now in 2025? The most important takeaway is that we are entering another cycle. The Fed has pivoted from tightening to loosening. History suggests Bitcoin and other risk assets could see significant upside during this phase. But the question is, will this time be different? One major difference is institutional adoption. Unlike in 2020, when crypto was still viewed as speculative and fringe, in 2025, Bitcoin is being bought by pension funds, traded in ETFs, and considered part of serious asset allocations. That means price moves may be bigger and faster because the money flowing in is no longer just from retail traders, it's from Wall Street. But institutions also bring new challenges. Regulations are tighter, the government is watching more closely, and any negative news, such as ETF rejections, exchange hacks, or regulatory lawsuits, can trigger massive corrections. Let's also think about the broader market. Stocks in the US have reacted positively to the rate cut, but not with the same intensity as Bitcoin. Why? Because corporate profits still depend on real economic growth, and a slowing economy isn't automatically great news for companies. Bitcoin, on the other hand, is seen as outside of the traditional economy. It doesn't rely on sales, earnings, or supply chains. It thrives on sentiment, scarcity, and belief. That's why the Fed's actions seem to affect Bitcoin even more than the stock market in certain moments. But here's the nuance. Just because Bitcoin is flying high today doesn't mean you should throw all your money into it. Smart investors diversify. In the US, financial planners are recommending allocations like 5 to 10% of portfolios in crypto, balanced with stocks, bonds, and alternative assets. This way you get exposure to upside without risking everything on volatility. Now let's talk risk management, because this is where most people get hurt. Bitcoin is famous for its sharp drawdowns. Imagine investing at $117K only to watch it drop back to $80K in a month. That's not a fantasy, that's crypto reality. The same forces that drive it up, momentum, speculation, and institutional flows, can reverse just as violently. And in an uncertain global economy, shocks can come from anywhere. A banking crisis, geopolitical conflict, or even a surprising policy reversal from the Fed. And yet, despite these risks, Bitcoin's long-term trajectory keeps surprising skeptics. Every cycle, it climbs higher than before. Every crash, it recovers. And each time, more serious players adopt it. That's why in the US and across other markets like the UK, Canada, and Australia, people aren't just asking, should I buy Bitcoin? They're asking, how do I buy it responsibly? Let's look at an example. Suppose you're a US investor with $50,000 in savings. If you put $5,000 into Bitcoin ETFs, $30,000 into diversified US stocks, $10,000 into international markets, and $5,000 into bonds or cash, you're exposed to growth while staying protected. Contrast that with someone who bets their whole savings on Bitcoin at $117K. One approach is strategic wealth building. The other is gambling. Another angle worth considering is how Bitcoin affects the psychology of money. When people see massive gains, they often suffer from FOMO, the fear of missing out. This drives them to buy at peaks. Meanwhile, those who bought early and stayed patient are the ones who truly benefit. The lesson here isn't just about Bitcoin, it's about discipline. Rate cuts and market surges create noise, but the winners are those who think long-term and act with strategy, not emotion. Globally, countries are watching the US Fed and Bitcoin closely. In Canada and Australia, central banks often follow US monetary policy trends. That means lower rates could push investors in those countries to also look for higher-yielding assets, and Bitcoin becomes part of that conversation. In the UK, regulatory clarity around crypto has been increasing, making it easier for institutions to participate. So while the Fed's decision was made in Washington, the ripple effects are global. Now, let's imagine what could happen in the next 6 months. If the Fed continues to cut rates and inflation remains under control, Bitcoin could climb even higher, perhaps testing $130K or beyond. But if inflation resurges and the Fed is forced to reverse course, markets could panic, and Bitcoin could tumble. That's why investors must pay attention not just to headlines, but to deeper trends in employment, inflation, and monetary policy. As we wrap this up, remember this: the story of Bitcoin and the Fed isn't just about crypto. It's about understanding how money moves in a world where policy, psychology, and technology collide. It's about seeing opportunities, but also respecting risks. And, most importantly, it's about building wealth in a way that lasts. So if you're watching this in the US or anywhere around the world, here's the challenge. Don't just ask, how high can Bitcoin go? Ask, how does Bitcoin fit into my long-term financial plan? Because wealth isn't built in a single trade. It's built through strategy, patience, and the wisdom to adapt when the rules of money change. If you found this breakdown valuable, make sure to like this video, subscribe to Wealth Hub, and share your thoughts in the comments. Where do you see Bitcoin going by the end of the year? 130K, 150K, or something completely unexpected? Let's talk about it.